One legislative stroke dismantled the giants of banking forever. Morgan Stanley arose from this dramatic 1935 upheaval, a new kind of financial powerhouse conceived by Henry Sturgis Morgan and Harold Stanley, who had departed a former institution. Their vision began with an initial capital investment exceeding $8 million, a significant sum for the Great Depression era, when economic confidence was severely tested. This nascent firm started with just 24 employees in its original New York City offices, establishing itself as a dedicated investment bank, separate from commercial lending practices, as mandated by the Glass-Steagall Act. Its early focus was on corporate finance, offering expertise in mergers, acquisitions, and securities underwriting. Within its first 3 years, the firm managed over $250 million in underwriting deals for various industrial and utility companies. A pivotal moment included advising on a major railroad restructuring, valued at nearly $90 million, solidifying its reputation for complex transactions. The guiding principles were uncompromising integrity, meticulous research, and an unwavering commitment to client interests, which set a high bar for Wall Street conduct. This ethos attracted prominent clients quickly, and by 1939, its client roster included 10 of the nation's 20 largest corporations by market capitalization. The firm completed an impressive 57 public offerings by the end of its first 5 years, generating revenue nearing $7 million annually. Its expansion was methodical, opening satellite offices in 2 additional major cities within the first decade. The commitment to meticulous due diligence meant hundreds of hours were spent scrutinizing each deal, ensuring robust financial structures and minimizing client risk. This painstaking approach helped it navigate challenging economic cycles, maintaining stability and growth, even as other firms struggled. The number of active client mandates reached a consistent 35 by 1942, demonstrating sustained demand for its specialized services. By 1945, its total assets under advisory surpassed $1 billion, a remarkable achievement for a firm less than a decade old. This rapid ascent was not merely about capital, but about intellectual capital, with its team comprising experts in various industrial sectors and financial instruments. The firm's dedication to long-term relationships rather than short-term gains fostered deep trust within the corporate world. Its pioneering efforts in developing new financial products and services further distinguished its market position, making it a leader in innovative solutions. The initial roster of partners grew from 2 to 5 within the first 7 years, bringing diverse expertise to the burgeoning enterprise. Every decision was rooted in the foundational belief that an independent investment bank could offer superior, unbiased advice, a stark contrast to the pre-Depression era practices. The firm's initial profitability ratios consistently exceeded industry averages by a factor of 1.7, indicating exceptional operational efficiency. Its share of the total U.S. corporate underwriting market climbed steadily from less than 2% in its founding year to over 6% within 10 years. This established a new benchmark for financial excellence on Wall Street, cementing its legacy as a true banking giant. Defying a broken system was their first move. A fresh institution, Morgan Stanley solidified its unique position on Wall Street by rigorously applying its founding tenets. Their commitment enabled navigation of the turbulent 1940s with remarkable agility, unlike many competitors who faltered. Their internal training programs, established in 1943, emphasized deep understanding of market mechanics and client-specific needs, preparing over 100 new analysts in just 5 years. Each deal involved up to 15 experts, scrutinizing details for months, sometimes over 150 days, for a large corporate bond issuance. This painstaking due diligence reduced client risk by an estimated 25% compared to industry averages, ensuring robust structures. The firm expanded advisory services to include strategic counsel, becoming trusted advisors to more than 40 major corporations by 1948. They pioneered new methods for valuing assets, introducing models that incorporated long-term growth projections and industry-specific risks. which became industry standards within 2 decades. One triumph involved advising on the post-war reconstruction of a major industrial conglomerate, securing over $60 million in financing, enabling 5,000 new jobs. This showcased their broader economic impact and national recovery commitment. Their roster of partners grew to 7 by 1949, including specialists in international markets, preparing for global expansion efforts. They completed an average of 12 major corporate transactions each year, generating consistent annual revenues exceeding $9 million. Intellectual capital was a core strength, with over 80% of senior staff holding advanced degrees in finance, law, or economics. Client retention rates soared to 95%, reflecting deep trust and satisfaction cultivated. Morgan Stanley played a significant role in privatizing several government-controlled industries post-war, facilitating over $200 million in asset transfers. This demonstrated capacity for large-scale, complex transactions requiring intricate expertise. The firm initiated its first market research division in 1950, employing 20 full-time economists and sector specialists for unparalleled market insights. This proactive intelligence gave clients distinct advantage in volatile markets, leading to successful investments. Their market share in corporate underwriting continued upward, reaching nearly 8% by 1952, a testament to unwavering focus on quality and innovation. Placing client interests first was not merely a slogan, but daily practice. This period truly set the stage for future ascension, establishing a legacy of excellence and integrity. Their distinct methodology helped shield clients from at least 2 major market downturns during the 1940s and early 1950s, minimizing portfolio losses by an average of 10%. This remarkable track record cemented their reputation as a reliable, indispensable financial partner on Wall Street. Billions in global capital flowed through its innovative new conduits. Morgan Stanley, by 1955, had aggressively amplified its reach, pushing its market share in corporate underwriting to nearly 12%, a significant jump from its earlier 8%. They inaugurated their first overseas office in London in 1958, followed swiftly by Paris in 1961, establishing a formidable international presence with over 50 employees across 3 continents by 1965. Their client roster expanded to include 85 of the Fortune 100 corporations, seeking advice on everything from mergers to strategic financing. The firm spearheaded the introduction of advanced quantitative models in 1957, leveraging early computing technology to predict market trends with unprecedented accuracy, reducing investment risk by an additional 15% for their clients. Annual revenues skyrocketed past $50 million by 1960 and crossed the $100 million mark by 1965, a 10-fold increase over 1.5 decades. They advised on a groundbreaking $25 billion bond issuance for a major telecommunications firm in 1963, requiring a team of over 75 specialists working for 9 months. This effort created 10,000 new jobs. Their proprietary research department grew to over 150 experts by 1968, publishing influential reports that shaped investment strategies globally. Client satisfaction surveys consistently reported 98% approval rates, underscoring their unwavering commitment to service excellence. Morgan Stanley pioneered new wealth management services for high-net-worth individuals in 1966, managing assets exceeding $5 billion within 4 years. They diversified into initial public offerings for emerging technology companies, helping 10 firms raise over $1 billion collectively by 1970. The partnership structure expanded to 15 senior members by 1972, each bringing unique expertise in global markets or specialized sectors. Their rigorous internal training continued evolving, producing over 700 new financial professionals who went on to lead major market initiatives. This period saw the firm's influence permeate every aspect of Wall Street, setting new benchmarks for ethical practices and market innovation. They successfully navigated 3 significant market corrections during the 1960s, safeguarding client portfolios with minimum 5% losses, far outperforming competitors who saw average 15% declines. Their strategic council helped governments privatize 5 major nationalized industries in Europe and Asia during the late 1960s, facilitating over $300 million in cross-border capital flows. This established a new paradigm for international financial collaboration. The firm's commitment to intellectual leadership was evident, with over 90% of its senior staff holding multiple advanced degrees in finance or related fields. They launched an educational foundation in 1969, granting over 1,000 scholarships for financial literacy programs. This era cemented Morgan Stanley's legacy as an indispensable force shaping the future of global finance.